Okay, good afternoon, class. Today we are going to look at introduction to bookkeeping and accounting. And under this topic, we shall look at the definition of bookkeeping and accounting, the difference between bookkeeping and accounting, and the users of accounting information or financial statements. And finally, we shall look at the importance or benefit of bookkeeping and accounting. Okay, now let's start with what is bookkeeping. Bookkeeping is the systematic recording of the daily financial transactions of an organization so that the financial position of a business can be readily ascertained or determined at any time. Bookkeeping is a systematic way of recording daily transaction of an entity. What this means is that a business make transactions on daily basis, and in that case, all the transactions need to be recorded. You need to document those transactions. You make sales, you purchase goods, you make an expense, revenue, whatever it is, whatever you do in that your business, you need to put it in writing. So that recording is what is known as bookkeeping. That is what is known as bookkeeping. Then let's look at the definition of accounting. Accounting is the act of recording, classifying, analyzing, summarizing, interpreting, and communicating financial information of an organization to various end users. What this means is that accounting is more advanced than bookkeeping. Accounting is the act of recording, classifying, analyzing, summarizing, interpreting, and communicating financial information. In a situation whereby you are into business, you have your daily recording. That's your daily recording, which we define as bookkeeping. So that's your daily recording. What do you do with it? You have to now classify the transactions, your recording. This is your purchase, this is your sales, this is an expense. You have to classify all the recording, the transactions you made. You have to classify them. After classifying them, what do? You now analyze the transactions. You need to analyze them and summarize them because you are recording it on daily basis. What do you do after that? You must summarize it because it's not everybody that will go through all your transactions. Okay, what is the summary of that transaction? Let's assume you say, okay, today I made a sales of, let's say, 50,000 naira, and you have an expense of 10,000 naira. So what is your profit there is 40,000 naira. So this is a summary, but under this your sales, you will have like, let's say, like 10 or 20 transactions under that. Then under your expense of this 10,000 naira, you have a lot of transactions. Let's say 5 naira for transportation, 3 naira for feeding, blah, blah, this and that. So you just summarize it as 10,000 naira. So that is what summarizing means. Then you now interpret it. You interpret it. What is this 50,000 naira? This 50,000 naira is your total sales for a day, for a week, for a month, whatever it is. This, your 10,000 naira is your total expense for that particular period. That is what interpretation means here. Then you now communicate this information. You communicate this information to who? To the users of that financial statement. We are going to discuss the users of the financial statement later in this video. Then you now communicate this to those who are going to make use of this information. That is accounting. So now we shall look at the difference between bookkeeping and accounting. By mere looking, when you look at the definition of these two terms, bookkeeping and accounting, they are not the same. This bookkeeping is a daily recording, while accounting is a recording, classifying, analyzing, summarizing, interpreting, and communicating the financial information. That is accounting. So there are different. There are two different things. Now let's look at the difference between the two terms. One, bookkeeping concentrates only on routine recording transactions. As I earlier said, it's a daily recording. So it's a routine activities. You record it on daily basis. Then while accounting goes beyond the aspect of recording, accounting goes beyond the aspect of just recording. Accounting will classify, will analyze, will summarize, and interpret those recordings. So that is why accounting is beyond just recording. This is one of the difference between accounting and bookkeeping. Then the second one is bookkeeping is limited in scope. Limited in scope means it's just to record. That is bookkeeping. It's just to record. After recording, that is all. Then accounting is very wide. You have to analyze, you have to summarize, you have to classify, you have to interpret, you communicate to the users of that financial statement. So it's wide. That is another difference of bookkeeping and accounting. Number three, we have the time required for training to be a qualified bookkeeper is shorter. For you to become a bookkeeper, it's very short. The time required is short. It's very easy for you to become a bookkeeper. It's just a recording. So that one is easier. But while if you want to become a qualified accountant, you have to pass through a lot of trainings. The years, the time frame is not the same with that of a bookkeeper. That is another difference. And number four, bookkeeping bookkeeping records mainly for internal use. When we say bookkeeping, we use it for internal use only. Why? Because you want to have record of all your transactions. So you use it internally. While book accounting is used both internally and externally. So you can use that to make your decisions internally, and you also use accounting to report your activities to the external users, and that sometimes to stock exchange, potentially. We are going to look at that very soon after this. Then number five, bookkeeping is an integral part of accounting. Bookkeeping is just a small aspect, small part of accounting, while accounting is complex and has a bookkeeping as one of its components. Accounting has bookkeeping as one of its components and is more complex than bookkeeping. That is it. Then we are now going to look at the users of accounting information or financial statement. As I explained earlier, said accounting is the act of recording, classifying, analyzing, summarizing, interpreting and communicating financial information of an organization to users of that particular financial information. Who are the users? Now we are going to look at the users of that information. After you prepare everything, you have to take it to those that will make use of that information. Who are going to make use of that information? Number one, we have owners of the business, those who invested their money, those who put their money into this business. They have to look at how is the business going. They have to see all this. Yes. One, they have to determine the profitability of that business. Is that business making profit or not? So that is why they need that information. And you must give them the information. And they also assess the ability of the company to pay they also assess the competency of those managers, those that are managing the business. They have to use that to assess them. Are they competent enough to manage their business? And it also helps them in making investment decisions. If that business is giving them what they need, what else do they need? They will invest in that business again. That is why they need this information. Then we have shareholders of a company. The shareholders of a company, they also need this information. Either, let's assume they're potential shareholder. You want to invest in this business. Okay, you must look at the financial statement of this business. Is this business making profit or not? If it's not making profit, why will you invest your money in it? You cannot. So that is why the potential shareholders, they need this information in order to make their decision whether to invest in the business or not. Then we have lenders, those who grant loan to this company. They have to confirm the status of that business. How will they do that? They have to go through the financial statement of that business. If I give this business this loan that they are requesting, will they pay this back? Do they have the capacity to pay back this loan? This is what you have to look at. Okay, even if I give them this loan, will they be able to pay the loan plus the interest? If yes, fine. And you must give me security before I give this, grant this loan to you. Okay, what are you going to give me as a security? Maybe the asset of the business. Okay, how will I confirm that you have this asset? I have to go through your financial statement. That is lenders. Then number 4, we have suppliers. Who are these suppliers? Suppliers, those that supply goods to the company. You want to supply, maybe say, okay, you supply good, I will pay you after 30 days. That is, you supply goods on credit. The payment terms is you will be paid after 30 days of delivery. Okay, I don't know your financial status. How will I supply goods on credit? I need your financial statement to go through it. Okay, if I now supply this good, will this guy pay me my money as at when due? I'm into business. You have to pay this money as at when due. How will I confirm? I have to go through your financial statement. That is it. Then have competitors. Competitors, they are those who are into the same line of business with you. Why do they need your financial statement? They need your financial statement in order to know how they will re-strategize. In a situation whereby you have a turnover of 10 million naira and their turnover within that period is 8 million naira. So then they now have to look into their business. What happened? Why is it that your turnover is higher than mine? What are you doing different from what I'm doing? So they have to think and bring up issues that will solve their problem. They have to bring up strategies that will help them to meet up with this 10 million naira or even above that 10 million naira. Have customers. Why do customers need this? They need this in order to make sure that the source of their product or materials, whatever they are buying from you, is not going to cease. For instance, now, there are some companies that you cannot lift any product without you making payments. You pay before you lift any product from them or you collect any product from them. Okay, how sure am I that if I make this payment, these people are going to give me this product? How will I confirm that? I have to go through their financial statements. Going through their financial statement will help me to know, yes, I can pay in this money. They will definitely give me the product. So thank you, everyone. And this is where we come to the end of this class. Thank you so much.